Mr. Darling joins us live now from Westminster. And Mr. Darling, I just want to start by talking about Europe's response to the debt crisis. We'll talk about that in a moment. First, so I just wanted to ask you about these latest figures that we're getting on UK inflation coming in at 5.2% in the month of September, matching the record high of September 2008. How worried should we be about this?
Well, these figures are high, and I just hope the governor of the bank is right in saying that he expects inflation to come back down over the next 12 months. And if they do come back down, then the whole thing is dealable with. I think the bigger risk to our economy at the moment is the fact that growth appears to have stopped, and it appears to have stopped from about a year ago. And, you know, it's a similar problem in the Eurozone. And it is the lack of growth that worries me far more at the moment than what I hope is a relatively brief period of high inflation. Although, you know, make no mistake about it, these figures are a problem both in the short term politically, because they will add to the pressure on a lot of families on middle and low incomes. And of course, experience shows that once you get inflation into the system, it does take a long time to get it back out again. But on balance, I think the Bank of England is right in the interest rate policy, and it's certainly, the bank is now very, very worried about the lack of growth. That's why it agreed to the quantitative easing over a week ago.
As you say, Mr. Darling, when we talk about inflation of more than 5%, we're talking about a situation that is eating into people's spending power, it's eating into their wages, and then, of course, at the same time, you have the Bank of England's decision to launch a second round of quantitative easing. Is that the right way forward in light of these inflation figures?
Well, I think that the announcement by the bank last week had an awful lot more to do with its worry about what's happening to the economy as a whole, as opposed to deflationary pressures, certainly coming from energy prices and so on. Because the real risk is that everywhere else in the economy, the pressure is all in one direction, and that is slowly but surely killing off the growth that we had. And I think a combination of the present government's policies of trying to cut the deficit very fast, and I think too fast, together with what's happening in the Eurozone, all of that is making the bank extremely worried. And the bank, of course, went along with this as part of an unwritten deal, I think, between the bank and the government after the general election last year. But I think the signs are now that people are beginning to think that just maybe they've got this wrong, and their judgment about how fast you reduce your rate of borrowing may be having effects that they didn't anticipate, though a lot of us did.
So given the slowdown in growth that we have had that you described, do you think then that we could well see further rounds of quantitative easing, perhaps QE3, QE4?
Well, at the moment I don't see it, but of course you can't rule it out. Remember, even 3 months ago, there was really only one voice on the bank's Monetary Policy Committee, Adam Posen, who has consistently called for more quantitative easing because his view is that the stimulus that we put into the economy is being taken out too quickly, and that was bound to have an adverse effect. But the rest of the MPC has clearly come round to his way of thinking, or at least a majority of them have, and that's why they agreed to it. But I think it is a measure of just how much the view in the bank has changed over the last few months, from being one that is broadly supportive of what the government is doing to one where it's actually doing the government's job for it. And of course the Chancellor, my successor, George Osborne, has said that he's going to announce new measures, that's new money, on top of this to help with business credit. Now, I think that's a welcome step, but it is just showing that what you're seeing here in this country is there is a change in the attitude towards the authorities, and the plans they have are beginning to adapt. Call it Plan B or whatever you want. It is a change, and there's no mistake about that.
And Mr. Darling, would you say that that change is a good thing, that it shows that at least the government is, and the Treasury specifically, is actually responding to events with a scheme like this one in terms of easing credit for businesses?
Well, yes, I do think so, because I've always thought that the approach taken by the government from 2010 last year was wrong. I mean, our economy was growing after the general election. It's now stopped growing, and if they change tack and accept that what they're doing is having all sorts of consequences that they didn't anticipate, as I say, other people did, but they didn't anticipate it, well, that's all to the good. But it won't, the quantitative easing on its own will not be enough. Easing business credit will help, but it won't be enough on its own. I think the government's got to recognise that it needs to just have a good, long, hard look at what it's doing in the rest of our economy. And of course, as you've been discussing in your programme today, and indeed for the last few months, until we sort out the problems in the Eurozone, until Europe also realises that the austerity programmes that it's imposing right across the piece are simply not working, and indeed they're counterproductive, then this lack of confidence is going to get worse and worse, with really very bad effects on growth.
And you speak about the situation in the Eurozone right now, and there was this real sense of optimism after the G20 summit in Paris that European leaders would finally come up with a long-lasting solution to the debt crisis. And then, of course, you had German officials yesterday saying, listen, if you think that's what you're going to get in a week's time, you're wrong. Are Eurozone policymakers doing enough to solve their problems?
No, they're not doing nearly enough, and they're not doing it quick enough. Look, we've been here before so many times. The last meeting of the European finance ministers I attended in May 2010, at that time we knew the problems in Greece. At that time we knew it was almost certain that Greece was going to default at some stage, and yet the plan they came up with then, it was adequate, except it was never seen through because the money didn't come forward. The Eurozone's had another couple of goes at it, and this weekend is just so typical of what they do. They march everyone up to the top of the hill, and then the next day they march them back down again. And it's not surprising that markets and others are beginning to wonder whether or not they are ever going to come up with anything that does the trick. What they need to do is to accept once and for all that Greece cannot meet its obligations. There has to be a restructuring of its loans. They need a fund that is large enough not just to deal with Greece, but to deal with any other countries that get into trouble. And remember that we could be talking about far bigger countries than the likes of Greece and Portugal and so on. And unless you see that, and unless you see action, not words, unless you see a done deal that actually works, then this crisis is going to continue, if not get worse.
But we're dealing with a very complex situation, are we not? These calls for the European leaders to take bolder actions, to be swifter about it, have been echoed many times over. We hear that again and again. But before we see any serious restructuring of Greece, we have to be sure that the banks in Europe are strong enough to withstand these losses.
Yes, but we've had 18 months to do that. I mean, I remember appearing on this programme a few months ago when I said that the stress tests wouldn't be worth the paper they were written on them because they didn't take into account the connections between banks, and they specifically excluded the possibility of a sovereign default. Well, guess what? A few months later, we're now openly talking about Greece defaulting one way or another, and we're now, admitting that many banks, particularly in continental Europe, need shored up. Of course, you've got to do the same things, but in relation to your complexity point, in 2008, when we recapitalised the banks, it was complex. It wasn't straightforward. All I can say is that by comparison, when you look at what's happening today, they're just making a complete mountain out of this problem, because they will not sit down and actually accept the inevitable and then ask themselves, what do you need to have to deal with?
So when we talk about the banks specifically, do you think that we should see recapitalisation on a pan-European coordinated sort of level, or is it then more realistic for this process to move more quickly for individual European countries to take care of their own banks?
Well, look, only the individual regulators, national regulators, actually know the true state of affairs of their banks. And what I would say to them is that if you know there's a problem, then deal with it. The money may have to come from the public, or some of them may be able to raise capital, though at the moment that might be difficult. But it does need to be done at the same time. The reason that our plan worked in 2008 was that in the UK, all the banks, and I mean all the banks, were looked at. Some of them were able to raise money themselves, some of them didn't have to do very much at all, but of course in the case of RBS and HBOS, only the government could do something about that. Now, by dealing with all the British banks at the same time, that helped the markets be reassured that we were doing something about it. The same thing did not happen in continental Europe. Some of the banks were recapitalised, but they need to do more.
Excuse me for interrupting, but if I can then just ask you, do you think that we do need to see forced recapitalisation? Do you think we need to see Eurozone policymakers say, listen, they say to the banks, you're taking the money whether you need it or not?
Well, obviously if a bank doesn't need capital, then the argument for saying you've got to have more, it isn't a strong one. But the trouble is that there are banks in Europe that do need more capital, and if it's the case that Greece is going to default, which I think now people are now openly talking about it in government circles, then we need to make sure now, i.e. in the next few days, that action is taken where banks need to be strengthened. Now that's the lessons of 3 years ago. Is if you don't do that, you are just asking for trouble, and I think the markets know it. And certainly all these mixed messages coming out of Berlin, coming out of other European capitals, it's not helping, and it's not instilling the sense of confidence that we desperately need.
Former UK Chancellor Alistair Darling, good to talk to you.
Thank you very much.